21-2 is talking about deferrals. We have 4 learning objectives. Record an entry to receive cash on deferred revenue. Calculate the amount and record the entry for deferred revenue when earned. Record an entry to pay cash on a deferred expense, and then calculate the amount and record the entry for a deferred expense when incurred. So first of all, deferred revenue is cash received for goods or services which have not yet been provided. It could also be called unearned revenue. So what we're talking about here is we've received cash for things that we haven't yet provided. We haven't given them the goods or the services yet, but they're paying us. On November 1st, it says that we received cash for 3 months rent in advance, $4,500, receipt number 905. So they're paying us for 3 months of rent. However, they haven't used that rent for 3 months, or that building, whatever it might be. So what we're going to do is we're going to debit our cash, and we're going to credit unearned rent income. Now, make sure that you pay attention to this. More than likely, that will be on your test. Unearned rent income is an account that decreases with a debit and increases with a credit. Okay? If we think of income, sales on the right side of the equation, it increases on the right. Okay? So when we put that into our journal, since we are receiving cash, it's going to go into our cash receipts journal. We have the date. We have our debit to unearned rent income. And then we have our credit. Oops, sorry. I said that the wrong way, didn't I? We have our debit to cash, and then we have our credit to our unearned rent income. Okay, document number is receipt number 905. Okay, so now what we need to look at is how much of that was deferred. So we're going to record an adjusting entry for that deferred revenue earned. So we're going to take the total rent that we received divided by the number of months to get how much rent was for each month. So we received $4,500. We had 3 months of rent. That means that each month was $1,500. Okay, so now we're going to look at our rent per month times the number of months to get our amount of adjustment. So $1,500, we have 2 months of rent that we earned, and so that amount adjustment would be $3,000. So what we're going to do is we're going to do adjusting entry. So we're going to debit unearned rent income for $3,000, and then we're going to credit rent income for $3,000. So when we look at this unearned rent income, notice our new balance after that adjustment will be $1,500. So that means that we've been paid for 1 month of rent that we haven't actually used yet. Okay? Then our rent income, we got 2 months of rent, so that would be $3,000. Okay, so this is an adjusting entry. So remember, we'd have that heading adjusting entries. We put in our date, we put a debit to unearned rent income, and a credit to rent income. Notice rent income here. It's going to decrease with a debit and increase with a credit. Record an expense paid in advance. So this would be deferred expenses, which would be payments for goods or services which have not yet been received. So this is just looking on the flip side of it, where before we were looking at rent that we had received from a tenant that was renting from us. Now what we're looking at is when we pay for a good or a service that we have not yet received. So on November 1st, it says that we're paying cash for 3 months rent in advance, $4,500, check number 231. So it looks like now we're paying the rent in advance before we have actually received that service. So we are going to have prepaid rent as a new account. Okay, prepaid rent is going to increase on the debit side and it's going to decrease on the credit side. So we are prepaying our rent. So we're going to debit, we're going to increase that for $4,500, and then we're going to decrease our cash for $4,500. Since we are paying cash, that's going to go into our cash payments journal. we're going to have a debit to our prepaid rent and a credit to cash. So if we think of this, this is a lot like prepaid insurance. Okay, we're paying that insurance. Okay, we're crediting cash and we're debiting prepaid insurance. Okay, next we're going to record the adjusting entry for the deferred expenses that were incurred. So just like we did last time, we're going to take the total rent that we paid divided by the number of months that we paid for to get our rent per month. So it's going to be the same as last time. 4,500 divided by 3 would mean $1,500 of rent each month. Okay, then we're going to take the rent per month times the months that we have actually used, and then that will be the amount of the adjustment. So $1,500 per month, we have 2 months, and so that amount of adjustment is $3,000. So we're going to debit. This is going to be an expense of our business. So this is different than what we saw before, because when we pay rent, that's an expense of running our business. We have to pay rent to be able to run our business. Okay, so we're going to debit our expense account for $3,000, and we're going to credit our prepaid rent for $3,000. That's not prepaid anymore because we've used it up. If you remember the step before, we are looking at November 1st when we prepaid. So those 2 months, how we figured out 2 months is we looked at November and December of rent. That's where we got 2 months for $3,000. Okay, we've already paid January, but it's not yet January. So again, this will go into our general journal under our adjusting entries heading. We're going to debit rent expense and we're going to credit prepaid insurance. Okay, last little bit then, it just talks about analyzing deferrals. The adjusting entries for deferred revenue and deferred expenses must be recorded at the end of a fiscal period in order for the financial statements to be accurate. Otherwise, it looks like we paid for rent for those months when we haven't actually used. Okay? Each entry for a deferral affects a balance sheet account and an income statement account. So that's going to make a difference in what our financial statements will say. And then if a deferral entry is not recorded, both the balance sheet and the income statement are going to be incorrect. Let's look at the questions. Audit your understanding. Number 1, when a business receives cash for services that will be performed in the future, what type of account is going to be credited? That would be a liability account. Number 2, the adjusting entry for deferred expenses that have now been incurred includes a debit to what type of account? That would be an expense account. That is the end of the lecture for 21-2. You can now open the 21-2 work together video.